So we're going to start on chapter 9 tonight. Remember I told you that you should appreciate those easy chapters we've been going through? Well, now it's going to be a little more challenging. So tonight we're going to do partnership operations and partnership dispositions, selling your partnership interest. Because you four haven't read the chapters. Did you read these chapters? So nobody in this class has actually read the chapters except for me. So what I'm going to do is do this a little differently, because it's, unless you just follow the book. Does anybody need a yellow highlighter or anything? You guys good? But that's about all you can do is highlight what I've highlighted. Okay. So a partnership is an untaxed flow-through entity, right? Everybody has got that part. It flows through your 1040, and you have a lot of separate, you have the income, which is just say the income minus the normal expenses. But there's a lot of items that are what we call flow-through items. Your 179, your interest, your dividends. They're going to give us a list of all that in here in a few pages. Okay? The separately stated items, I'm not sure where they're going to give it, but it's in a page or two. Okay, you should identify the difference loss limitation rules. Pre-contribution gain must be identified. Okay, so we're starting into a business. I give a piece of property that's worth $100,000. My basis in the property is $100,000. But the fair market, so when I give it to for my partnership interest, I give them a piece of property worth $100,000. They give me 25% of the partnership. Everybody good? My basis in the partnership is the $100,000 property that I gave them. They get that $100,000 property, and it's on their books at $100,000. But the fair market value of that property could have been $140,000, $150,000. So we have pre-contribution gain that under certain circumstances it's going to be recognized. And what they're going to tell you is, I think if you sell it to somebody else or do something with it in certain circumstances, that the person that gave that might have to take that as income if it gets sold. We'll go into that. Okay, so if we go to the next page, 228, partnership operations, partnership taxable income, partnership incurs liabilities. You know, I'm not going to be able to keep going up and down. I can't. But I gave them a $100,000 piece of property. But it had a $40,000 loan mortgage on that property. Everybody get this? So I get $100,000 for 25%. My basis is $100,000 for 25%. A $40,000 loan, I got out of $40,000 mortgage. The partnership now has this. I'm 1/4 of it. So we would either do 3/4 times this, that reduces my basis, or another way is the partnership so we're now down to 60, but 1/4 of that is actually I still have that as my portion of the mortgage. I'm still liable for 1/4 because I'm a 25% owner. So I would add back $10,000, and I'd have a basis of $70,000 now. Okay, there's two ways to do it. I personally would do it the shortcut way. I'd say 25% of this, so 75% is what we subtract. So instead of doing 2 steps, I would have just said 30,000, which is 75% of this, and then we'd have 70,000. You can do it either way, it doesn't matter, as long as you understand it. What does that mean? Okay, so let's do it the other way.
So that means your share is 70,000?
No, no.
Or they-
Okay, I gave a $100,000 piece of property to the partnership. My basis in the partnership is $100,000. But if my property had a $40,000 mortgage, each partner now has a fourth of that mortgage, if everybody each had 25%. Okay, so 3 partners had 10,000, 10,000, 10,000. I got relief of 30,000. Now I only owe 10,000. The other partners owe this. So you would subtract that from my basis. That would be loan relief, and I would have 70,000, which is just a different way of doing what I was just doing a while ago. Okay, this is the way I would do it, and that's really their percentage is 75%. My percentage is 25. So take 75% times that, it's 30,000. When I'm doing the problems, whatever you do when you're doing these problems for these chapters, write it all out. I actually do it in my book. So now my book kind of marked up if anybody wants to borrow it. Okay, so now my basis is $70,000. Okay? So we borrow another 40,000. Let's see, no, we borrow another 20,000. And mine is one, so the partnership borrows $20,000 and I'm 25%. So what would that be? $5,000. Now I've increased my loan amount by 5,000, and so now my basis is 75,000. Everybody see how that goes? And we haven't even started working yet. I just got into the partnership. I gave them my property. They took my loan. Now we borrow some more money. So now my basis is 75 grand. That's on January 1st. Then, during the year, we make money, lose money. Let's just say we make $80,000. Nice round. So we made $80,000, and it's all just income minus expenses. No separately stated items. Okay? Then it would just be 80. So what is my percentage of that? 25%. So 25% of 80, 1/4 would be, what do you guys guess? 20? I'm trying to get you guys to say something. It's not working so good. So now I've got that increased my basis by 20,000. Now my basis is 95,000. Everybody good with that? It doesn't, and I haven't taken a penny out. If I took a distribution of, let's just say they gave me cash as part of my profits. Because normally, if I'm in a partnership, I can't be an employee. Okay, everybody got that? Huh?
If you're in a partnership.
If I'm a partner in a partnership, I'm not an employee. I'm a partner. There's something else I could be. I can have a guaranteed income. Okay, so if the partnership gives me guaranteed income, that would be part of their expenses, and that would be part of that 80,000. But I'm trying to just get this flow through. So now, if there was any other things going on, we could change our basis. if at the end of the year I go, okay, each partner says, we did real good this year, we're gonna each take out $15,000 as a distribution. Normally, is that gonna be taxable income to us? No. A distribution is not taxable income until it goes over this 95. So now our basis is $80,000. I have no problem.
So your basis is
80,000, yeah. But, oh no, we had a hurricane and it tore up my house. I need to take out X number of more dollars. If the partnership would let me do it, I go, I want to take out $90,000 now. We're in the next year, but we haven't finished the year yet, right? I want to take out 90,000. It looks like we're going to have a really good year. But right now, so I take out $90,000.
I don't understand you. We're in the next year, but we haven't finished the year yet.
No, we remember we already made $80,000 for the year before. That's
okay.
And I took my share.
Yeah.
Then after that, I had a basis of 95.
Uh-huh.
We got a distribution of each of 15,000. That would be 60,000. But we had enough money to do this because we were something. I don't know what happened. We had a bunch of money, and I thought I want to take out 90 grand. My basis is only 80 grand. So now I've taken out more. But the truth is, I can't go down to but zero. So what happens? That last $10,000, it becomes capital gain. And normally it's going to be a long-term capital gain if I've been in the partnership for over a year. Okay, and before we start doing all this stuff, I want to just kind of give you just a flow through of how. Now, there's going to be a lot more complicated stuff we're getting ready to go over. But we'll get to that in a minute. But does everybody get the general idea how this works? You start by putting something into the partnership. That starts your basis. You can give them property. If you have a mortgage on your property, you got rid of that mortgage, so that reduces your basis. If the partnership took out a loan, your portion of the loan would increase your basis. Okay? Then when the partnership made income, that increases your basis. When you get a distribution, that decreases your basis. And then now we're going to get ready to go through the book. Okay, here we go. Okay. Glasses, sorry guys. Okay, so we're still on page 228. Partnership incurred liabilities. They increase your basis. That's just what we talked about. Recourse liabilities versus non-recourse liabilities. If it's a recourse liability, and let's say I'm one of the partners, and I'm the only one that has a recourse liability. I'm the only one that has to pay it back. If that's the case, I'm the only one that gets to increase my basis by the amount of liability. If all of us have an equal pay, we equally have to pay back that liability, then whatever it is, I would pay my share. If it was 25%, I would have to pay 25% of the liability. I would increase my basis by 25% of the liability. Everybody get that? Okay, a partner who pays more than his or her proportionate share of a partnership debt that becomes uncollectible is permitted to take a bad debt write-off. So, I'm in a partnership with these guys. We're closing down the partnership. One of the partners is a bad guy. He runs off to the mainland, doesn't pay his debts. We can't find him. we have to pay his liability for him. We get to write that off as a bad debt. That would be a business bad debt, as opposed to a non-business bad debt limited to $3,000. Okay, organizational fees and syndication fees. We've already gone over this several times before, but we'll hit it real quick. Organizational fees, remember you can write off the first $5,000 in the first year that you start your business. So if before I started my business, I had to go out and pay rent, train my employees, buy some stuff, whatever that might be that I wanted to buy, okay? Then those would be startup costs to start the business. I'd had to maybe even have a lawyer do some things for me, okay? Then the year that I start my business, let's say that same year or the following year, I get to start writing off the startup costs. If it's $5,000, I can write off the first year, and everything else, what do I have to do? Amortize it over 180 months, which is like 15 years. But you do it by the month, so if it's so many months, that's it. Okay? You guys should know this already, but if you're on a cash basis, you have to pay the expenses before you can write them off the startup cost. Syndicated fees are not, you can't advertise them. The cost of issuing and marketing partnership interest. What do you do with these things if you can't? You hold them in the corporation, okay? And then when you sell our partnership or whatever we're dealing with, then when you sell it, then you get to deduct those against whatever you get. So let's just say it was $10,000 of organizational costs, and I sold the business for $100,000. I get to subtract those $10,000 from the expenses, only have $9,000, and then if my basis was less than $90,000, that would be my capital gain. Is everybody? I'm trying to make this up. I don't have a good example in the book. Okay, you go to page 229. We've already talked about partnerships taxable income. So your taxable income is just like it was a Schedule C, a partnership, an S corp. It's your income minus all your expenses you can write off. You get to your taxable income, right? And if there's no separately stated item, that goes actually in box 1. And then it increased your basis. It also goes to your tax return, and you've got to pay tax on your income. So if you were a 25% owner and the income was $100,000, you would get $25,000 in your box 1. It would carry to page 2 of Schedule E, and you'd have $25,000 of income. You'd pay tax on that $25,000. You'd probably get the GBI, the 199A. You get to subtract 20% of it, probably. And you would also pay income tax and self-employment tax. So one of the things I don't like about partnerships, why I don't recommend them a lot, is that all their income is self-employed income. So all that income that you're getting on your partnership, you got to pay Social Security self-employment tax. An S corporation, on the other hand, I'm getting off the beaten path, but an S corporation, on the other hand, makes you an employee for a certain portion of the income, and the other income comes to you as not as self-employed income, just as income. It still goes on page 2 of Schedule E, where you have a W-2 that goes on line 7. I don't know if it's still line 7. It used to be line 7. And by the way, I guess I told you this already, they're getting ready to change the tax form again. Yeah, elderly one. I haven't, I don't know for sure, but unless it's a law that I have to, I'm not gonna use that elderly 1040. I'm gonna put everybody on a 1040. You can't, same, you know, you can't use a 1040 easy, you can't use a 1040A. So you can use a 1040 or, but it's just gonna make it more complicated to use the elderly 1040, which is only for people over 65. I'm not sure what the point is for that. I believe it's, huh?
Bigger funds. They should make the whole thing bigger.
Yeah. Okay. So we get down on page 229, down at the minute, it says separately stated items. You need to know these things. So these are the things that are separately stated on your K1. So they're not considered part of the income and expenses. So let's just, here's a real good one. You had $100,000 of income, you had $40,000 of expenses, $60,000. But you had 179 of another 20,000. Okay? So your income really was not 60,000, it was 40,000 to the partnership. But 179 and a bunch of this other stuff, it's decided at the partnership level. That means the partnership decides they want to take 179. And if I'm a 25% owner, I would have 25%, so I have 15,000 in box 1, and I have 1/4 of this, or 5,000, 179. That would go on my K1. But just because the partnership can take the 179, you may or may not, according to what else is going on in your life. Everybody understand how that works? The 5,000 goes to your 4562, but there could be other limitations. Remember, you could have an income limit. You could have another business, and it's got more than, well, it'd have to have, what is it? How many million is it now before you start phasing out your 179? I forgot. Is it 2.5 million? No. 25 million. I don't know. I can't remember. But anyway, it's really high. But in the old days, you could phase out real quick for a low amount. So most likely you're going to be able to take that, okay? But it would go on a 4562, separate from the K1. The K1 goes on page 2 of Schedule E. Okay, so we have a lot of other things there. What are we looking about? Short-term capital gains, long-term capital gains, interest, dividend, non-taxable interest, non-taxable expenses. None of those go inside the income statement, okay? They go separately stated. And so what does that mean? So on your K1, if you had interest, dividends, they go straight from the K1 and they would go to your Schedule B. In the old days, it would be line 8 and 9. And I have no idea what the numbers are going to be this year. They showed us when we were at, I think, they showed us a copy of what it was going to be, the new 1040, but I'm not sure if I ever did that or not. But everybody understands. What else do we have you have to worry about? Depletion on oil and gas, foreign income tax paid or accrued, charity contributions. All these are separately stated items, and they don't go on the K1 on line 1. They go wherever they go on the tax return. And each person may be done differently. So they're on for the whole partnership one way, but for One guy, he may not get to take the charitable contributions because he gave a lot of other charitable contributions himself, and he's already got over 50–60% of his income. I think is it still at 60% now? Unbelievable. You got to be a really good person to get 60%. Or you're a little old lady that doesn't have much income, but you're really rich. I've had that happen a couple of times. You know, the lady couldn't give all the money she gave away, couldn't count it because she didn't have enough income. I should be so lucky.
Yeah.
Or you could. Okay, so have I missed any? Investment income and related expenses, rental activity, portfolio income. So you need to know this whole list. You're not going to have a complicated problem with all that. It would take too long, but they would give you something like this. They'll list 3 of these and they'll list something that's not on there. Okay. The partnership's distributed share. So that's what we're really talking about. The partnership agreement includes modifications up to the partnership return due date without extensions. So after, when is a partnership due? 2.5 months after the due date. So if you were a December 31st, your calendar year, it would be March 15th. But in partnerships, they can be all over everywhere because anybody can be in a partnership. Another partnership, a corporation, anybody. So they got all kinds of, did we go over the rules for that last time? Was that? Yeah, so if one guy owns more than 50%, you have to use his ending date for his year for the partnership ending date. If several people together add up to more than 50% and they all have different dates, didn't I show you how to calculate that last week? I did, honest. Remember I said your percentage times the number of months from the ending date, and we did it for each one? How soon they forget. Okay, that's always a question, by the way. Okay, so the gain, okay. A partner generally must recognize gain on the distribution of property, other than money, if the partner contributed appreciated party to the partnership within 7 years. So, okay, here's what we're talking about. I gave the company, I had a basis, I'll use B for basis, and it's worth $150,000. I contributed that property to the company, and within 7 years, they sold that gave it to another partner or something different. And let's say when they gave it out, it was worth the same 150. That makes it easy. Then the $50,000 difference, the partnership would have to count as income, and they would distribute it back to the partner that gave them this. So if I'm a 25% share, I would get the distribution of the gain because I gave them property, the basis was this, and it was really worth this. So somebody got out of paying the $50,000 gain when they transferred the property, and that's a way for the government to get the money back. If you wait more than 7 years, No harm, no foul.
Say that again, so if it's over 7 years, then.
Then you don't do that. They just sell the property at whatever value.
Okay, and then each partner would have, the 25% distribution that they would have to pay top
Yeah,
against
but
that.
if you sell it within the first 7 years, the partner that gave the money is the one that would recapture this,
Okay.
50 grand.
So the other partners that did give that property, it doesn't affect them at all?
Right.
Oh.
Well, the partnership would take the gain and then distribute it to that guy,
Oh.
as opposed to each person, because he got the benefit. Okay, the character of a distributed share of partnership items is generally determined at the partnership level. So, the same thing, if you want to give away 179, the partnership determines how much is 179, how much is maker's depreciation, how much is bonus depreciation. The partnership determines it. And then distributed share goes to all the partners. So one partner, he may have a bunch of stuff that it would be a great year for him to take that 179. The next guy, it doesn't do him any good, and so he would not like that. But the partnership makes it. And how does the partnership make that? The partners get to vote. If one guy has more than 50%, then he gets to vote. Of course, he's not going to have any friends in the partnership if he treats everybody else crummy. Okay, so partnerships, you can buy in. Now your partnership, your profit and loss ratio, you can have a partnership agreement where it's different. It doesn't always have to be everybody gets the same amount. One guy can get 60 and one guy can get 40, one guy can get 25, and one guy could have 75, or one guy could have 25, another guy could have 40, and the other guy have whatever, 35, whatever's left. Election by partnership or partner. A few elections available to partnerships. This is on 232. These are the things the partnerships get to elect, and then right below it is what the partner gets to elect. So the method of accounting, accrual versus cash. Computing depreciation. Do I want bonus depreciation, 179? That's a big one. Installment method election. Expensive intangible drilling and development costs. Those are things the partnership chooses, but they could affect the way the income comes out. Okay, so the partners make the following. If they get a deduction or a credit on foreign income taxes paid, you know, you can either take foreign income taxes off as taxes on your Schedule A, or you can take a credit with, what's that stupid number? Oh, well, God, no. But there is a credit. That's it. My mind went blank, I couldn't think of it. Okay, what's another one? Treatment of mining and exploration expenditures. After they get it, they can choose what to do. Basis reduction following discharge of indebtedness. There's not that much. You're liable to get a problem about that. That's an easy one. Adjustments to basis. You guys are just going to have to read this and learn it. Memorize it would be the best thing. But it says all these pluses and minuses, your initial basis, you put more money in, obviously your basis goes up. You have your distributed share of partnership taxable income. That's the net income of the partnership. That makes it go up. You increase your share of the liabilities. That makes it go up. and then there's a bunch of stuff that makes it go down. Okay. And so at the end of the year, you're going to have adjusted basis. And the way you do it is you pretend that everything happens on the last day of the partnership is the best way. And example 9.3, at your own time, you guys need to read through this. And I suggest you do what I do is write out when they say 15,000, the taxpayer's owning base in the partnership is 50%. 15,000 and 15,000 is separately expended at the beginning of the year. I guess that's the basis. Is 15,000. So he started off with 15,000. Then the partnership had ordinary income of 8,000. He's a 50% owner, so he would have 4,000. That would increase his basic. That's his income. A distributed share of partnership income is what they like to call it. Charitable contributions of 3,000. Well, that would his charitable contribution would decrease his basis. But if it's 3,000, how much does he get? Half, because he's a 50%er. And so it would go down by 1,500. And make a distribution to the... So he had a distribution of 5,000. That means they gave, when you have a distribution to a partnership, that's not taxable income, but it reduces your basis in your partnership. So they gave him $5,000 cash. When they had that $8,000 worth of income, they didn't give him anything. But he still pays taxes on his share of the 8,000. So you take all that up and you ended up with some kind of basis. Okay? Pretty much that's the nut and bolts of what goes on all of these. They're going to give you probably one problem like this. It's not going to be real complicated, but they're going to give you one, something like just like this. And you got to figure you're not going to have all the stuff in there. You're only going to have some. So you'll know that 179 would be subtracted. Charitable contributions would be subtracted. A decrease in liabilities would be subtracted. An increase in liabilities would be an addition. Okay. Okay, loss limit. Partnership's ordinary loss is a negative balance of taxable income. So, if your distributed share of income is a minus number, this is where it's going to get tricky for all of us in the future. Starting this last year, they're wanting us to have the basis and put it in the tax returns we do, the 1040s. So they want us to calculate basis. And if somebody walks into your office and he goes, well, who's been doing your taxes for the last 4 years? Oh, I've been doing them on TurboTax. And what is your basis in your partnership? What's a basis? Ooh. We have a challenge. I can tell you the rule. The IRS rule is, and I even asked this when I was in a seminar with an IRS lady. The rule is, if you don't know the basis is 0. If you can't calculate it within a reasonable amount, and you got at least some validation of how you calculate it, then you got to say it's 0. What does that mean? They lose money in their business. They can't take a loss because they have no basis. When they sell their business, they have no basis. It's all gain. They're just shooting themselves in the foot. Thank you, TurboTax. Okay. To recognize a loss beyond the partner's basis is interesting. The distributor must be a liquidity. So, is there a case where you can take a loss? Yes. If it's a liquidating distribution. That means I'm selling my portion of the partnership. This is it. Liquidating the partner's entire interest. Can't be a portion. Has to be tied. Made in the form of money, unrealized receivables, and inventory items. You can't take property. If my basis in the thing is $10,000 and they only give me $3,000 for my basis, and that's it, I have a $7,000 loss. That's a capital loss. I get to throw that on my 1040 as Schedule D. Okay? If on the other hand, I don't know what my basis is, then my basis is 0 and I've just gotten a big gain. And probably the customer's going to walk out and go back to TurboTax and just make it up. I hope not. Okay? So, at-risk rules. Everybody understand at-risk rules? A partnership's loss currently deductible as long as you're a material participant in the partnership. What would that be where you're not? Limited partner? A limited partner is at risk in the partnership to the extent of contributions and his or her share of qualified non-recourse financing. That is the amount that the partner would lose if the partnership suddenly became worthless. Okay? Passive activity losses are deducted in the current year only to the extent of gains from passive activities. You guys are going to have to, no matter what, you're going to have to read this yourselves. Otherwise, that looks like I'm going to be reading the whole thing to you. And it takes a lot longer to do that. Okay, if you give a partnership interest, no gain is recognized. Okay? Unless the partnership liabilities exceed the basis. Okay? My basis in the partnership is 10 grand. I give that to my son, then he has the basis, it's a gift, there is no gain or loss. But if I give him a 10 grand basis, but I owe 20 grand to the partnership, in effect, he gave me $10,000 for my gift. So if your liability relief is bigger than your basis, you have a gain up to the amount between liability relief and basis. Okay, and number C, you read this yourself. If you give it to a minor, it is presumed the minor is controlled by others, therefore there are limits on the amount that can be allocated to a minor. If there's only myself and my 10-year-old son, and I give him a 50% basis in the business, and the money that's made is from me doing tax returns, he's not doing anything for it, then they're going to say, no, you can't give him half the profits. Inheritance, okay. The successor has a fair market value basis in the interest. So if the fair market value of the partnership was $40,000, but the basis is $20,000, he would get it. He'd get the new basis at $40,000, I believe. And I'm not even sure about that. Reporting requirements of a partnership. Okay, this they're going to ask you about. A partnership is required to file an initial return for the first year in which it receives income and incurs expenses. So we start a partnership in November. We file the papers. We don't make any money. We don't have any expenses. It's a year-end partnership. So that first year we don't have to actually file a tax return. But you might want to do it even if put all zeros in there just for whatever it's worth. But you don't have to. But if we had a little bit of income, a little bit of expenses, then you got to file. What does it say for not filing? I hope it says it in here, but it's about $200 per month per partner. Oh, down below down there. You can look at all this. This looks a little different than the rules that I know. If it's not more than 30 days late, it's only $50 per return. The people that we get coming in here are a year late or 2 years late. And you go, oh, we didn't know we had to file a partnership return. And they go, what does this letter from the IRS say? You owe $10,000. And that's not for anything but just not filing. Okay, so a partnership is required to file a tax return. A partnership with more than 100 partners they got to file. It says magnetic tape, but it's really e-file now, I believe. I don't know if it's still magnetic tape or not. Any partnership item that vary tax liability to a partner is separately stated. For separately stated 1031 gains and losses, a copy of the partnership 4797 sale of business property should be attached to the K1. I don't know if they're going to ask you that, but I highlighted it anyway. And the same thing right below here, somewhere on the next page, Form 8308 is filed. If you're going to put something in the partnership K1 that doesn't match the 1065, you've got to get this extra form in there. Wait. Before we get there, so what did I've already told you, March 15th, 2.5 months. And under H, on the top of 235, it says inadequate filing. Penalty is imposed on the amount of it's $200 for each of up to 12 months times the number of partners or people. So everybody get that? So you got 5 partners, 2,400 times 5, you're $12,000 penalty for the first year. Okay, so what am I telling you? They gotta file the tax return even if they didn't make any money. And that's now, if they've never done anything wrong, does everybody know about first time abatement? The first time you get caught and you're in trouble, you can ask for a first time abatement if you've been a good person before that. Okay, when a partnership is notified of an exchange of partnership interests involving unrealized receivables, inventory items, the partnership must file the 8308. Okay? Good luck with that. And then if they don't find out until later, they got 30 days to file it. You might get that question. Okay.
Return is due on the 3rd one, right? That's why you keep seeing the 2nd one.
The 15th day after the second, so 2.5 months. The 15th day of the 3rd month is 2.5 months. So January, February, on March 15th it's due. 2.5 months. It would say, or you can say the middle of the 3rd month. Either way you want to say it. Which is 2.5 months. Okay, you got an ending of December 31st. Your tax return is due as March 15th. That's January, February, and a half. So 2.5 months. Or you could say the middle of the 3rd month is the same, saying the exact same thing in a different way. No,
that'd be a month and a half.
that's a month and a half.
December 31st is the end date.
Yeah. So January 31st would be 1 month, February.
There's December
another
12,
month, and then
31,
March 1st to the 15th is
January.
1.5 month.
Right.
February, March, 1, 2 and a half. Or the middle of the third month. Either way you want to do that.
Yeah, you're
Okay?
right. Okay.
That has been that's also going to be a test question. That's one of the easy ones. But, and what they're going to do is, they're not going to have a December 31st. They're going to say something like September 30th. September, October, November, December 15th would be your due date. 2.5 months. Or the middle of the third month. Either way, they're both the same. Okay, reporting on QBI. I'm not going to go through. You're going to have to just read this. There's two. We could take up too much. Distribution of partnership assets. Okay. Anytime they give you money, loan relief, or any property, that's a distribution. Okay? So, a distribution, on most cases, as long as your basis is higher than the distribution, it's not taxable. So if I have a $100,000 basis in my company and they give me $50,000, my basis went from 100 grand to 50 grand, but that 50 grand is not taxable to me. Everybody got that? What was taxable? Earlier, when they gave us my portion of the distribution from the income, the company made a profit of $90,000, and I'm a 50% owner, $45,000 would have increased my basis, and I have to pay tax on that $45,000. That goes on my tax return, with all the other separately stated items. Current distributions, they reduce your basis. A decrease in the partner's share of liabilities is a distribution of money. My share of the liabilities is $10,000. The company pays it off. I reduce my basis by $10,000. If, on the other hand, the company goes out and borrows, let's say I'm a half owner, $20,000, I increase my basis by $10,000. I'm out 2.5 months. Okay, so property distribution. If it's only money, it gets real simple, right? I've got a basis, I get money. As long as my basis is bigger than the money, I'm okay. My basis is 50 grand. They can give me all the way up to 50 grand in cash, and it just reduces my basis. If they gave me 45 grand, now my basis is down to 5,000. No problem. They gave me $60,000 in cash. My basis is only 50. We've got a problem. In effect, they gave me more money than I've got basis, so I have a gain of $10,000. If I've had this partnership, if I've had a partnership ownership of more than a year, it's long term. If it's not long term, then it would be ordinary income short term. if you're lucky, that's an easy problem. If they give you one like that. And they do have it in there.
I have a question.
Go ahead.
Okay, so you have, you pay the $10,000 capital gains or whatever on it.
Uh-huh. Now
And
your basis is
will-
0.
So your basis will never be less than 0. It's always gonna be 0.
That's right.
So if there was, like the following year, there was a loss, your basis would still be 0. How does that work?
You're right. But let's say, so your basis is 0, and next year you have a loss of $8,000. That's a suspended loss. You can't take it because your basis is 0. So, even though on the K1 you had a minus 8,000, that's what the IRS is trying to stop. People just not knowing any better and taking that $8,000 loss. So now your basis is at 0. You have a suspended $8,000 loss. The next year, okay, the company makes $40,000. It goes on your K1 next year. So, I'm not sure if the software can get it right. It should be able to, but the software would go $40,000 would go on page 2 of the Schedule E, but you get to subtract the $8,000 you had from the year before, and so you would only pay tax on $32,000. And
now
you
your
would
basis
now
is-
your basis would go to 32,000.
Oh. Oh. So the suspended losses would kick in the same time you have a profit,
Yeah.
and that it changes your basis.
And if the next year you had another loss, it'd just add the loss.
Okay.
And then when you get the profit, if your loss is 8,000, you got a 40,000. That would increase your basis by 40,000. You already had an $8,000 loss. Now your new basis is now 32,000. This is a different way of giving, instead of just reading this stuff out of the book, which wouldn't help you for the problem. That's why I'm spending so much time doing this. Does everybody get this? This is the problems you're going to have. I was waiting while I'm up here. Okay, the next thing is you got a $40,000 basis, and you get a distribution, sale or whatever. You get a distribution of $20,000 cash. This cash, and you have inventory. The inventory basis is 15,000, but it really has a fair market value of 20. You would get this $15,000 and it would go here, brings your basis down to 5. You still don't have any gain. If you sold that inventory, I believe it's 5 years. If you sold it in 5 years, then and whatever you sold it for more than the 15,000 would be ordinary income. That's in here somewhere. I got that probably out of order, but it'll probably come up later. But that would also be a question in there somehow. There's a lot more to all this stuff. The only way you're really going to get it is you guys have got to read the chapters. After you read the chapters, start doing the problems. Get the problem wrong, go back and read that portion again. I've been doing this for 15 years, teaching the same stuff, and it still gets me. The tricky is this. When you start getting in here, remember that you've got to take your percentages. If you're a 25% owner and the whole gain is 8,000. Well, you only take 2,000. I've already missed that one today on what I just was running through it and go, ah, man, I forgot that it's only a percentage. We took the whole, took the whole amount. That works well. Okay. Property distributions, pre-contribution gains. We've already gone over that to an extent. It's going to take too long to go through that whole thing. We've already talked about it, but there's problem 9-4. You're going to just have to read this because it would take 30 minutes just to go through that one problem. Partners dealing with their own partnerships. Okay, this is another thing that we've already gone over 2 or 3 different times, but related party deals. So you got a partnership. You own more than 50% of partnership ABC. Your wife or dad owns partnership XYZ, or you own both of them. Either way, you both own more than 50%. You do a transaction together. If there's a gain, how does the gain go? It's ordinary income, right? If there's a loss, what happens to the loss? The loss is suspended. We've gone through this. So, my dad and I do a business deal. We each own a partnership. His basis and a piece of property is 10 grand. I give him 8 grand for it. He lost 2 grand. He can't take his 2 grand loss. My basis is 8 grand. If I sell this property for 7 grand, I get a 1 grand loss. Everybody understand that? I can't, okay? My basis was 8. I could have a 1 grand loss. On the other hand, I sell the property for 11 grand. What is my gain? It's a trick question. Come on, somebody. 1. I get to take this suspended gain from there. I get to add that, and so I only have to pay tax on 1 grand, not 3. We've already gone through that. I was in part 1 before. Everybody remember this, kinda? Okay, so anytime you get partnerships or partnerships, corporations, partnership and individual, or individual, any of these combinations, they're going to throw that problem in there for you. You're going to one guy's going to own more than 50%. The other, his brother, sister, dad, child, is going to own a different company more than 50%. They're not, if it's a loss, they don't get to take the loss. If it's a gain, the gain is ordinary income. Okay, guaranteed payments. Okay, I have a partnership and I'm working for that partnership, and the partnership says, look, you're our best salesman. We're going to give you a guaranteed payment of $20,000 a year. No matter what you get $20,000 on top of your portion of our partnerships. That $20,000 goes where? On the K1 as a guaranteed payment. It's a payment. It's $20,000 of income to him, but it's a business expense to the partnership. Okay. So the partnership has income of 100 grand. Their other expenses were 60 grand, but we gave 20 grand guaranteed payment. So in effect, that's 80,000. The partnership has 20,000 of income. Let's say there's 2 partners. And so each partner would get 10. So partner one got 20,000 of guaranteed income and 10,000 of partnership income, and in effect got 30,000. 30,000 would go to page 2 of the Schedule E. Everybody good with that? Let's go to the next one. The partners make a deal. Partner A goes, we're going to give you 50% of the partnership income, but not less than 20,000. Okay? So, if they have 100 grand minus 40, so they make 60 grand or 30 each. That 30,000 is more than the 20, so they each get 30,000. No problem, right? On the other hand, let's see here. They had 60,000, so they've now got 40. No, we don't want that. Yeah, we'll do 70. Okay, so their profit is 30,000. Okay, so if they split this, that's 15,000 each, right? But he's guaranteed 20,000. So he gets a minimum of 20,000, and he's going to get less. And they've got it worked out in there. I can't do it off the top of my head right now. I'd have, because I'm making these numbers up. But you'd subtract the guaranteed portion, and that would be an expense. And that lowers their income, okay. Guaranteed payment. But we'll get to there and I'll go over it. Partnership contribution. Partnership contributions to a self-employment retirement plan are not deductible by the partnership. You guys need to know that.
Where's that at?
Well, that's on page 239, the very bottom of the page under G2. And right above that, you'll see example 9-5. If you'll read that, that gives you a real good way of looking at all this. So, under the partnership agreement, Mina is to receive 30% of the partnership income, but not less than 13,000. The partnership net income is 30,000, so that would be 9,000. So she cannot get less than so $4,000 is so she gets her what? She gets a guaranteed 13,000, and the other 17,000 is divided between the partners. Okay, non-partner capacity, loans, services, property. Basically just read that. I can't add anything. Character and loss limit rules. We've already gone over this, right? That's what I was just talking about before, about related parties. And that's what related parties down at the end of the chapter is. All right, let me see if I marked any on here, on the problems. Here's a hard one. Thomas contributed real estate he held for investment to Frog Partnership, a dealer in real estate. The real estate had an adjusted basis to Thomas of $50,000 and a fair market value at the time of the transfer of $43,000. On June 1st, Frog sold the real estate for $40,000. So the basis was $50,000, they sold it for $40,000. What are the amounts and the character of the partnership loss? Sort of a trick question. It got me, that's why I marked it. So he has $50,000 of land, of something he puts into a real estate partnership. Okay, normally $50,000, they sold it for $40,000. Okay, what would that mean? You get a $10,000 loss?
What number is that? What number is that?
Oh, it's on page 243, number 7. Yep, you get a $10,000 loss. And what kind of loss? Capital loss, and if it's over a year, it would be long-term capital loss. Okay? $10,000. What's the flavor of it? This is where it's tricky. If it was just a piece of land, investment land, it would be a long-term capital loss. But the company they put it into was a real estate company, and so that's what their business was, buying and selling real estate. So that was really part of their inventory. So it's a trick, or it tricked me. So you would end up having a capital loss of 7 and an ordinary loss of 3. Because this is inventory to the company after it got there. And just review that and read it on yourself. That, I didn't realize that until after I'd already marked the wrong one. I try to cover up the answers so I can't see them when I'm doing these. Look at number 10 real quick on page 244. Partner C invested $30,000 cash for 60% interest in ABC. C materially participates. The only partnership debt of the year in was $15,000 loan from the bank. Partner C and the other general partner had separate agreement that C's liability would not exceed $10,000. Okay. The partnership reported a $70,000 ordinary loss for the year. What is the amount of C's deductible loss? So C started with a partnership investment of $30,000, right? And he on the loan amount, he's got an agreement that he doesn't have to. He's not liable for more than $10,000. You okay?
Yeah.
You need. So the basis had gone to $40,000, right? Even though the loan said $15,000, the only partnership debt at the end of the year was $15,000 loan from the bank. Partner C and the other general partner had a separate agreement that C's liability wouldn't exceed $10,000. So $30,000 plus 10 is $40,000. So how much is that he can take as a loss? $40,000. So what does that tell you? You have your basis that you start with, and if you take any loan amount, you add that to your basis. If the loan amount is $10,000 and you're a 50% owner, and both of you are liable, you get half of the $10,000. All right. How about a quick break for anybody? Bathroom break, everybody. More water. The good news, this chapter is bigger. The next chapter is way small. but they've got as many problems. In real life, these are the ones, if you're going to do somebody's partnership, this is what you got to know. What happens in the how do you get in the partnership? How do you start your basis? During the middle of the partnership, what happens? How do you keep track of the basis? Gains and losses and all this. Then now, this is a